Let's go to Wellington now, where we're joined by our business editor, Giles Beckford. Hi, Giles. Labour market numbers, they seem to be even better than you were suggesting they would be last week.
Indeed, John, they are really strong. Unemployment near a 9-year low, record numbers of jobs being created, record numbers of people in work, surging wage rates, as they say in the scam busters. If it sounds too good to be true, it probably is. Now, this is Stats New Zealand, so of course we believe their numbers, but with a pinch or two of salt. These labour market numbers are often volatile and leave themselves open to various interpretations and lots of revisions. So we smooth it out, I think, is probably the important thing. And we might have to say that we didn't create 56,000, the economy didn't create 56,000 jobs in the past 3 months, but perhaps in the past 6 months there may have been around 50-odd thousand jobs created, and that gives you an employment growth of around 1%. There's no doubting, though, that the labour market has got a little bit tighter, that there are still reasonable numbers of jobs being created, and this is in building sector, in the services, hospitality, retail sectors. They're all quite strong employers, and we might see a little bit more of that coming into the summer season, the holiday season. But there are those who are questioning whether we can sustain this degree of strength in the labour market, and that will probably start to manifest itself next year. Certainly the wages side of the numbers that we saw today, 1.9% was the annual growth rate in the sort of benchmark wages indicator. A part of that, as we said on Friday, was the equal pay settlement for the rest home sector. Take that out, and the wages rate actually went back a little bit. It slowed on the previous quarter. So there's still no great underlying impulse there in wage inflation. Having said that, as we were commenting last week, these numbers do start to take on a little bit more importance and will attract more attention as the Reserve Bank has to take them into account formally, in a formal sense, with the new writing instructions from the government. So we'll wait and see how that pans out. But for the time being, not too bad. We'll wait and see whether that continues for 2018.
A big clean out on the share market today, Giles. What happened and why?
Well, normally we would just do a quick, and here's the markets. But the share market at one stage was down 1.3%, more than 100 points. And that's a considerable clean out in anybody's reckoning. It was the biggest in months. It's closed down 92 points, just over 1%, 8,053 for the top 50 index. The main reason why was A2 milk. Now, that's been a big driver of the market in the past month. A2 milk, in fact, has been up somewhere in the region of 20-odd%, in fact, 30-odd% so far this month. And that's been behind the rally for the main market. There was a turn in sentiment. An Australian broker had put out a report saying they think it was overblown, that it will be, in fact, an underperformer. One of the reasons why A2 milk's been so popular, and with it the supplier and maker of its milk powder, Synlait Milk, which is the South Island dairy company, is because they've got favoured status in China, which is one of their key markets. They've got the necessary certification, so their prospects there look very good. But a dose of reality had to come, and today seems to have been it. It was down 12% at one stage. A2 milk closed today down about 8.5%, but still a little bit of reckoning there, a little dose of reality. Also more weakness for Fletcher Building and Metro Glass, two stocks in the building sector who are well and truly out of favour. The currency, on the other hand, which had been on the back foot because of political uncertainty in the past couple of weeks, it perked up after those jobs numbers. I think essentially because investors overseas, the reef fish of the foreign currency markets, as David Longy would have called them, they're now betting that perhaps the Reserve Bank may have to take action to start tightening rates a little sooner than had been expected. The result of that is the Kiwi dollar gaining around 0.5 cent on the day, just touching 69 US cents and 89 Australian. In fact, 90 Australian, I should say, not 89.
Giles Beckford, our business editor. Thanks very much indeed, Giles.